And welcome back. Just a short while ago, we were talking about Africa's first ratings agency. We speak about this now, the significance thereof and likely impact with Four Rivers policy and economic analyst, Ms. Lebohang Pheko. A very good evening to you, and thank you so much for speaking to us. Perhaps let's just start by establishing the rationale behind these Western ratings agency. They are seen by some as non-democratic, untransparent. What were they actually meant to achieve?
So originally, ratings agencies came about in the different stages of the early 20th century, and they were actually originally before the big three. There were several more of them, but very roughly, they came about between the two world wars, and they were resulting from the Depression. So it was a way of assessing whether or not companies were still viable. And of course, they're very much US-based. And at the time, they were also intended to see what was the cost of borrowing, the cost of lending. Worth also mentioning that these are private agencies, and that all of them are actually aligned to the U.S. Reserve Bank. And that, in fact, what has happened over the years is that in the 1970s, when different countries, and of course the IMF, the World Bank, wanted to secure and to understand the efficacy of a country's credit and the ability to pay back, they then began to hire these credit agencies to then assess whether or not a country debtor was going to be able to pay back their obligations. And of course, this was also to do with trying to avert default. And then later on, they then have, over the since the rise of globalization in the 1990s and certainly into the 2000s, the ascendancy, the primacy of these has become much, much greater. So, people like Moody at the time were trying to focus on railroad bands, and that has now become a whole new agency, and an agency over the last 100 years or so. And unfortunately, African countries, with the rise of structural adjustments, have then, and the liberalization of financial regulations, have then begun to use, ratings agencies almost as a way of de facto measuring their economic efficiency and their ability to attract international credit, i.e. northern credit.
And we'll look into the modeling in just a moment of these agencies, but as you were just given the timeline, I thought let's then look back to the 2008 financial crisis and how it impacted African countries and their activity on, say, the Eurobond market. How much did it contribute to the increasing deterioration of how the global debt markets pegged us?
So, I think the interesting thing about the last credit crunch, which was 2008, the one before this pandemic, is that it leads to the assertion that, in fact, the credit ratings agencies, especially the big three, as it were not as prophetic, I suppose, as one would have expected. And many people have written about how they're hurting African country economies, especially, Moody's and Fitch in particular, because they then oftentimes use logic or illogic. That's confusing and very puzzling. Oftentimes, 14 out of 21 rated African states have been given low ratings, such as high credit risk or very high credit risk, and yet, post-2008, it took 3 years. There was a 3-year lag before the U.S. economy was actually downgraded from the sterling blue chip AAA rating that it has enjoyed. And at the time, I think quite a few people called the ratings agencies false prophets of doom. So they've missed out and they've completely failed to read the room in several instances. They failed to read the 2008 subprime disaster and the U.S. financial contagion, which the rest of us had to catch. They also, prior to that, failed to read the Enron scandals, the Parmalat scandals, the dot-com scandals as well, the dot-com meltdown. So really, this notion that credit ratings agencies are firstly completely accurate Number two, completely non-politicized. And number three, completely rational, objective, and fair-handed in their assessment. Does not stand much to scrutiny. So that, they also didn't manage to pick up on the 1997 Asian crisis, for example. And there has been a lot of argument that they are, in fact, deeply, deeply embedded in the U.S. financial system, which is how the U.S. system, the U.S. economy, continues to maintain this prime AAA rating, even though clearly they are one of the most highly indebted countries in the world, and of course that their economy is not that healthy.
So this conditionality in terms of the modelling and just looking in terms of the efficacy of our economic systems, then does the dependency basically then dictate our development financing approach and even the agencies in terms of global capital markets and whom we issue bonds to?
Yeah, that's an interesting question, because international financial markets have basically opened a massive window for different governments across the world to expand their funding sources, whether it's multinational and multilateral institutions, whether it's through different forms of aid, and of course now they can also borrow issuing Eurobonds. So there's a whole menu, an eclectic menu of different options that are available to many countries, but these are still primarily issued in foreign currencies. And that is usually euros and dollars, which is the point of contention, because, of course, the dollarization of international markets leads to the high indebtedness of most other states, especially African Asian states, which are then forced to pay back these debts in dollars. And of course, we understand that with the fluctuating rand to dollar rate, or any currency to dollar rate, which is also linked to oil prices and many other vagaries which we have no control over, it becomes incredibly difficult and expensive for us. Another part of that is that even though people are enjoying the notion that we have different options, so you can borrow using Eurobonds, for example, and the first, I think South Africa was the first African country to issue Eurobonds in 1995, and I think 20 others have since sold Eurobonds. Okay. They're incredibly risky. And the high, and even though the yields are very high, it also means that the payment plans are very high. So, for example, countries like Angola, Egypt, which are still trying to pay back on the Eurobonds, you get 37%. Angola, Egypt, Kenya, up to 37% of their total tax revenue just on the interest repayment.
Ms. Pheko, because we are running out of time and I need to squeeze this question in, this development of our first credit ratings agency, how does it change our fortunes as African countries? Does it mean in terms of credit worthiness that we might see the issuing of bonds occurring within rather than externally?
Yeah, it remains to be seen, Kapiso. And I think that the modalities of credit ratings agencies, if we're actually developing something that's entirely devolved away from the international, and when I say international, that's the Euro-US system and the Euro-US economy, which is very prevalent and pervasive, then it means that potentially, if we're willing, for example, to experiment with things like just a basket of currencies so that we can then decide on our own balance of payments which are not related to the US dollar, and which will then potentially boost the value of our own currencies, for example. That would be one winning potential move as well. And the other thing is that as well, this particular ratings agency is aiming to show that the financial sector is actually quite stable across African countries, that our tax revenues are actually quite efficient, and most importantly, that our natural resource endowment is actually very strong. And of course, that never changes, right? The oil, the diamonds, the minerals remain there. And that this should show that we are able to pay back our debt. But on a very final note, I do want to caution us that as a model, I think it's not a good thing that so many governments, whether across the African continent in particular or globally, are so reliant on public debt and on sovereign debt to meet basic needs. There's something very wrong with our economies if that is the only mechanism that we have outside the system to basically run our country.
Thank you so much for your time and your insights. Much appreciated. Senior Research Fellow and Political Economist at Four Rivers. Ms. Lebohang Pheko, thank you very much.